Welcome back, traders and investors, to the Benzinga pre-market prep. It is the 9 o'clock hour, and we are here with Todd Gordon. He is the founder of the Trading Analysis, and he is also a contributor over at CNBC. Todd is well known for his ability to translate wave theory into clear and concise trading strategies. So hopefully we can get some input from you today, Todd, on a few earnings and perhaps talk some macro news. But first of all, how you doing this Monday morning, Todd?
I'm doing very well, very well. Thanks for having me, Garrett. Actually, I can't lie. I'm not doing that well. I have two twin boys who are going to be 1 year next week, and they're both teething, and they're both sick. So actually quite miserable.
I'd say I feel your pain, but I've never been in that boat, but I can imagine what it must be like.
Oh, man, it's fun. It's pretty awesome, but whole new work-life balance. But it's good. I'm up to the challenge. Let's do it.
Well, speaking of teeth and perhaps pulling a few, what do you think about some trades this week? It looks like, we were talking earlier about CVS, Coca-Cola, Tesla. Can I get some input from you on perhaps any of those three or anything else that you may be looking at just for earnings, get them out of the way?
Yeah, sure. To start, actually, you know what? Let's do Tesla first. I've got a little bit of commentary on CVS looking quite strong. I think there's a lot of bad news surrounding Tesla right now, a lot of fundamental news. And I'm a guy who, I like to trade what I see, not what I think. And I obviously I read the fundamental reports and try to be aware of what people are talking about. But I think this is a situation where there's a discrepancy between what people think actually should be happening in the chart and the market and what is happening. I'm seeing actually a pretty bullish structure here in Tesla, and I love the fundamental news being a little bearish. I think earnings are not expected to be great, and I am liking this base that Tesla kind of put in towards the 200 to the 190 level. I mean, I think anything close to expectations in Tesla actually might be in for a little bit of a long trade.
Yeah, it seems that way because most of the time when Tesla comes in, everybody's really bearish of it, and then it just comes in just close enough to perhaps expectations. And then, like I was saying earlier when we were speaking with, I think, Anne-Marie, that, Tesla ends up, or even before with Dennis, that Tesla ends up, issuing some sort of forecast. And that seems to be the thing that pushes it.
Yeah, exactly. I mean, it even just, sorry, I should turn my phones off. I don't know if that's coming through or not. Even just the response from, I forgot what the news was on January 13th. You probably know better than I would, Garrett. But, it gapped down, tried to push below the 200 level, and buyers just came in with a vengeance on decent volume, bringing it back up to 220 area. So, this whole gas argument of not needing a electronic car like Tesla. I mean, I don't see it as an electronic car. I don't see it as a solution there. I see it more of as a premium car. I mean, that's a luxury car. So I think it's kind of immune to this drop in gas prices.
Yeah, at least in January. What was it, Brianna? I think China sales in Google.
He was saying that there was weak China sales, and I think that's what
hit
it.
Right.
It was during the auto show when he was actually here with us in Detroit. And he said there was something to do with the charging stations. But I feel like I just saw news this morning that said they're boosting the number of charging stations that are going to be in China. So
See,
maybe
it's
that
expectations.
Won't be. It is. It's a lot of expectations. But Todd, I totally agree with you about. People who are buying Teslas are buying it because it's a luxury car.
Absolutely.
Yeah, exactly.
Absolutely. Guys who could drop. And then what people don't even talk about is it costs, what, 70, 80, 90 grand for, well, maybe not. What's the base? Price 60, 70 grand. But
yeah.
What is it to recharge the battery or replace the battery every second or third year? Isn't that another 20 or 30 grand?
Yeah.
I mean, don't quote me, but I'm pretty sure. I mean, you got, the end of the day, when you're done with the car in a couple of years, it's going to cost you 110 grand probably.
Mm-hmm.
What do you think about Tesla's plan to release the cars the way they did? I mean, they came out with a high-end car, and then they knocked it down a little bit and kind of came out with like what you may call a mid-range car. And now it sounds like they're prepping to come out with like a low-end car. It looks like they were trying to entice people by having quote unquote the rich people come in and buy the really expensive cars and then slowly work their way down.
Kind of set the brand loyalty, set the trends, and then filter down. I mean, it's not unlike a lot of laptop and cell phone companies that come out with the high-end products first, then they eventually move down that target audience, move down that average price. So it seems to be like a good model. I mean, I think it's awesome. I love it. I'd love to buy a Tesla here pretty soon, but I don't know if my wife will let me with twins in the back.
Well, I mean, if we're talking about returns on product and on plays, why don't we take a look perhaps at, I know you were mentioning Coca-Cola earlier too when we were talking before the show, and we're taking a look at Tesla now and some of their benefits. What do you think about Coca-Cola going forward? Warren Buffett was out saying he loves this stock, and he's never worried about it since he's owned it in, 1890, since the thing started, I think.
Yeah, the chart for me and the product is, it's a consumer staple, and staples are It's interesting. I'm just looking at my stats. Consumer staples, I'll just talk about that real quickly, have actually made a little bit of a rebound. XLP in the 3 month is actually the second strongest 3 month returner. So the staples are up 3.9% on the prior 3 months, where XLY, those discretionaries, are actually up double. So discretionary is where the action is right now. Coke being a major staple, it's in a decent trend. I don't love the chart. I think it's a range bound chart. It's a range bound stock with a moderate uptrend. So in terms of getting excited for earnings, it's just nothing that really gets me too fired up.
You're not excited about the dividend play at all? We were talking earlier that it seems like there's kind of a sentiment shift from asset appreciation potential into consistent payments, and I'm seeing Coca-Cola pays roughly a 3% dividend. What do you think of that?
Yeah, absolutely. But I mean, I think most of us, I mean, tell me if I'm wrong, but I think most of us listening here are looking for the trades, and dividends are certainly being talked about a lot, but is it being manifested in dynamic day-to-day or even week-to-week trading opportunities? I'm just not seeing it. So yes, longer-term capital, I just spent a good, I don't know, couple days just working out my longer term portfolio strategies. And yes, dividend payers are important, but in terms of trading inside of earnings seasons, it's not something that excites me.
Now, this might be a good lead-in, actually, because I kind of wanted to ask you a few macro questions, if you don't mind. And since we were
Sure.
talking about, the dividend play and people are kind of talking about stuff, but we haven't seen anything manifest yet, we've had a lot of rate talk going on lately. And I was one of the guys that was expecting a rate call in June, and I was, not even 2 weeks ago, I was still expecting it. And as I go through the data, and, I start looking at things like government interest expense and some of the potential dislocations that can come from a rate rise, I'm really, really reluctant that I was calling and maintaining a 2015 rate rise for June. What do you think is going to happen here with the market? It seems like a lot of people are, expectations kind of seem to be split, but the big money that seems to matter just keeps moving their forecasts out. What do you think the Fed's going to do on a macro basis with rates?
Yeah, I haven't looked at the federal funds. Have you looked at it? Is it October is the highest probability of a rate hike?
I haven't looked at the curve yet. The last time I looked at the curve, the high probability I want to say was September, October, but I can't remember specifically. I haven't looked in a few weeks, honestly.
Yeah, no, that's fine. I mean, there hasn't been much of a need until Friday. I mean, Friday's jobs was, I mean, that was big. The revisions, I mean, there was like 80,000 revisions in the prior couple months. That average hourly earnings up 0.5%, where last was a 0.2% drop, I think. The Fed has just been kind of sitting on the fact that companies aren't paying people more money. Well, now they are. The unemployment rate ticked up 0.1%, which is good because more people are coming back. Everything I saw in the market just was saying 2015 rate hike, and I'm with you, Garrett. I'm just looking at the rest of the world and just the dichotomy that exists between our central bank and the rest of the central banks. I haven't been trading that long. I guess about 15 years now, and I've never seen such a divergence, central bank policy divergence from one to the rest of the world. I mean, granted, it's the Fed, but the divergences are massive right now, what's happening in the rest of the world. And I just kept saying to my customers, I'm like, guys, I don't know how the Fed can think they can raise rates with what's going on, but these jobs numbers are getting stronger and stronger. So, you're seeing the bond market get crushed on Friday. Interest rates spiked. Utilities, which has been one of the strongest returning sectors in the last 12 months or so, got hammered on higher interest rates. Gold got crushed. I put a trade on in GLD. I put an options trade on. We could talk about that if you want. This US dollar rally is just doesn't stop. So all of these dynamics that we saw Friday, which was really nice volatility, was just the Fed moving towards a rate hike, which shocks me, but I just don't see how they can't with the strong data.
Yeah, I've been losing it since the beginning of the year. I keep bringing it up because I can't fathom the number of central banks that have taken some sort of interest rate action since January 1. I mean, I've counted 18 so far, and I didn't even know that Trinidad and Tobago had a central bank. Apparently they did because they raised their repurchase rate a few days ago. But
yeah.
How does this, you were talking about gold and GLD, and I also know that GLD basically moves on gold futures. How does a rate hike like this and this rate action globally, how does this play into sovereign wealth funds and these big players that may not take knee-jerk reactions to price, but use calculated moves, and these guys that are perhaps making loans to oil producers that now those, they're not getting a good rate of return on the loans for production because nobody's producing anything. How do you think all this kind of plays in? Do you think that there's a lot of this big money chasing after gold futures now, and guys that actually want to take physical delivery of gold as opposed to just exposure to, gold price movements through something like the GLD ETF.
I got to tell you, Garrett, you're a couple steps ahead of me in terms of who's actually behind the move. I'm just taking kind of on that same point, that line of discussion we were having before. I just feel like too many people like you and I over the last 3 to 4 months on GLD and gold, when it got down to the 1100 in the futures or whatever, came back having the same conversation you and I just had, that the Fed there's no way they're gonna have to raise rates. So the dollar started to teeter out a little bit. Gold started to get a little bit of a bid in the idea that the Fed was going to stay on hold for a longer period of time. And all of a sudden that was just completely reversed on Friday. Gold broke down through some pretty key levels. So we strapped on some pretty good GLD option positions on Friday. But in terms of who's taking delivery, I don't know really who's behind the trade. Again, I just think this is a central bank driven market, and all of a sudden we just U-turn saying, wow, maybe the Fed is going to hike.
With gold, where do we go with gold right now?
Let's see. What did we do? We just broke down. I'm just looking at the actual setup chart that we used. 1239 in that front month, the continuous contract was a big break. So it's interesting. Our style, let me even back up even further. Our style of analysis, basically we have plan A, plan B. We always go into battle with 2 plans. And I'm a big believer, practitioner, and I've been for years, of the Elliott wave theory. And a lot of people might kind of roll their eyes a little bit and say, oh, boy, Todd, you can tell me the market goes up or down from here. How does that help? Well, it actually helps tremendously. And here's my example. Gold was at such an interesting position. And I'm sorry to go on a tangent. I'll just circle back to your point.
Go right ahead.
Yeah, gold was at such an interesting point right around 1,300 in the futures. Basically, I had plan A, plan B, and I knew there was going to be a big move in gold. I just wasn't sure which way it was going to go. Basically, if we broke above 1,300, I would say after this NFP, after everything that's going on in the world, the Fed was locked down in terms of not hiking in 2015. And I saw gold going up another couple $100. I think Friday's report was so important that it actually disregarded or invalidated my primary count, and actually I had to move to the alternate count. The alternate count had a corrective rally from the 1100 low, 1120, whatever it was, a couple months ago, up to 1310. That was a 3-wave corrective rally. So the bounce that we saw in gold, by way of Friday's price action, said this is just a correction, and I think we're headed back below $1,000. And if you think back again, when gold was at 1150, whatever it was, the whole world was saying, oh yeah, gold for sure is going below 1,000. And isn't it just the sick and twisted way of the markets to take gold below $1,000, but from 1,300, not from 1,150? And that's what I think is happening now. So the failure, number one, at 1,300 pointed us to below 1,000. And number two, there was a key level 1240 front month futures contract that broke, and we are now leaning against that with shorts. So the trade we just put on with clients, let me just look at my GLD here. We did a 119, 114 March put debit spread. So basically, I think we paid about $2 for it. So we're risking about 950 to make 1,550. Not 2-to-1 risk reward, but being that we bought that put that was a little bit in the money, you have a little bit higher probability of success. So the trade's predicated on 1240 holding. We're coming back to it a little bit here, and I need to see some confirmation that that's right here on the open.
So what do you see shaping up then? I mean, if we've got oil going down, we've got rates down, we've got jobs that we're adding, we've got a strong dollar. I mean, is the U.S. setting up now to actually produce its own strength? Even though I've heard a lot of people comparing it to the nicest house on a bad street, are we setting ourselves up for actual strong economic growth here relative to the rest of the world, thanks to our position as a reserve currency and with our own sovereign central bank?
I do. I can't believe I'm saying it. Yes, I do think we are starting to produce our own energy, and I think this oil shock has come out. One of the things I need to do is look at that oil volatility here on the open. But I think we've settled in, and I think oil has been simply repriced. And the move down in oil is it's actually quite interesting. And I should have sent this chart over to you, but here's something that'll blow your mind. I think oil has just been simply repriced, and it was actually a very methodical, timely decline. It was high volatility and it scared everyone to death. But if you look back at the 2008 to 2009 credit crisis oil collapse, It started in about early July of 2008, and it lasted into the first week of February 2009. It lasted 31 weeks. If you fast forward to this most current crude oil collapse, it started in about July and it just ended in about February of 2015. It was also 31 weeks. So you had two major oil price resets that were exactly equal in terms of time. I think it was I'm a technical guy. It was a very symmetrical move. I think oil has set back into a new range, and I think markets have simply accepted now, if we can sidestep European deflation being sent over, then it's a good thing. And we can now start to build on lower input prices. If we can kind of sidestep some of these energy company defaults that everyone was talking about the last couple of months, then I think we can start to build a strong base. And I think the stock market goes substantially higher.
That was quite an amazing stat. So you basically see a rebalancing here. I wonder how this would look against inflation expectations if, the similar collapse back then.
Yeah.
Because the way that this price movement seemed to go, I would imagine that at some point somebody was losing a little control, but there seemed to be a little pressure perhaps coming from the U.S. government. None of this I can prove, but
sure,
just looking at the sentiment at the time, that kind of seemed to be the scenario. And
that's why I love. That's why I love getting up and doing this job, because the hairier, more volatile, and scarier markets get, the more rhythmical. That's not even a word, but it is for Benzinga. The more, you know what I'm saying, the more with pattern and with structure and with actual rhyme and reason that you can detect. When markets are calm and relaxed and just kind of floating around, that's when markets tend to wander through levels and stops, and they just trade in a lackadaisical manner. But when things are the craziest, when vol's high, is when markets trade the best. I mean, I love this market, especially we've reset in this new volatility range. Oh my God, the last 2 years, 13 to 15 in the VIX. Shoot me. But now we've reset in a much higher range, and I'm seeing technicals. I mean, I love trading these kind of markets. So, whatever the long-term implications are, we're having a lot of fun trading in here.
Yeah, it's definitely a very volatile market and a lot of fun right now. Well, thank you, Todd. I'm going to have to wrap it up there. I appreciate your input. That was a great, fantastic talk, and thanks for the tip on the...
My pleasure, guys. Thanks so much for having me.
Thanks for the tip on the oil correction. All right, so we were just speaking with Todd Gordon. He is a CNBC contributor and founder of Trading Analysis.